Let me ask you something. Are you absolutely sure you're paying the right tax on your holiday let? It's a huge question for property owners, and today, in this guide from Pro Tax Accountant, we are going to get you the answer. Now, that might sound a little too good to be true, right? But what if I told you that a shocking number of holiday let owners are overpaying thousands of pounds in council tax, all while a clear path to a £0 bill is just sitting there waiting for them? Well, let's find out how you can get on that path. Looking ahead to the 2025/26 tax year, getting your head around the system isn't just important, it's absolutely crucial. You know, this isn't just about ticking boxes and staying compliant. It's about turning what feels like a tax headache into a genuine financial advantage for you and your property. So here's our roadmap. We're going to start with the big tax problem that catches most people out. Then we'll look at how to unlock huge savings with something called business rates, and finally, how to future-proof your investment against all the changes coming down the line. Okay, let's dive right in. All right, first things first, let's get right to the heart of the problem. You see, by default, the taxman sees your lovely holiday let as just another second home, and believe me, that puts you on a very, very expensive path. So every holiday let owner, including you, is standing at a fork in the road. Path number one is council tax. It's the default route, and it often comes with some really painful extra charges. But path number two, well, that's business rates. This is for properties run like a real business, and it opens up a whole world of savings. The key is making sure you get on the right path. And here's the kicker. In England, local councils have the power to slap a premium of up to 100% on second homes. Yep, you heard that right. That means you could be paying double, literally double, the standard council tax rate, just because it's a holiday property. Let's make that real for a second. Imagine you've got a beautiful cottage down in Cornwall. A standard £2,000 council tax bill suddenly jumps to £4,000. That is $2,000 straight out of your pocket, gone from your profit, simply because of how your property is classified. And that's not all. Here's where most people go wrong. They just accept it. They think it's the cost of doing business, without ever realizing there's a way out. So, let's talk about that way out. This next section is all about how you can unlock business rates and wave goodbye to those crazy council tax premiums for good. Let's see exactly how this works. Okay, to make the switch from council tax to business rates in England, you have to prove your property is a genuine business. For the 2025/26 tax year, it all comes down to two clear rules. First, it has to be available for let for at least 140 days a year, and second, it must actually be let for at least 70 of those days. Simple as that. Now, here's a pro tip. Proving this is way easier than you might think. Did you know that your Airbnb or your Vrbo booking calendar is basically your secret weapon here? It creates a perfect, time-stamped digital paper trail of all your bookings and availability. So when the valuation office agency, the VOA, asks for proof, you've got it all ready to go. No fuss. Qualifying for business rates, that's the first big win. But this next part, well, this is where the real magic happens. This is the grand prize, the potential to get your tax bill all the way down to zero. Stay with me. The next point might surprise you. The key to all of this is a term called rateable value. Now, don't let the official sounding name intimidate you. It's really simple. It's just the VOA's official estimate of how much rent your property could fetch in a year. It's not what you actually earn, it's just their valuation. And it's this number that decides what kind of relief you can get. Now, what's really interesting about this slide is this magic number, £12,000. If your property's rateable value is £12,000 or less, and it's your only business property, you can apply for something called small business rate relief and get a 100% discount. Yep, your bill becomes zero. You pay absolutely nothing.
And this chart just shows you the incredible power of this. Let's imagine Sarah, a freelancer who owns a little holiday cottage in Devon. Her property's rateable value is £10,000. As you can see, stuck on council tax with that nasty premium, she's forking out £4,000 a year. But because her rateable value is under that magic £12,000 threshold, she applies for the relief, and boom, her bill is zero. That's a £4,000 saving every single year.
Look, a £0 bill is fantastic, right? But the benefits don't actually stop there. Once your property qualifies as a commercial business, what's officially known as a furnished holiday let, a whole new world of tax-saving tools opens up to you. Just take a look at this. Unlike a normal buy-to-let, you can deduct your full mortgage interest payments. You can claim tax relief on furnishings. We're talking everything from new sofas to a fancy hot tub through capital allowances.
You can even use the profits to make tax-efficient pension contributions. And, crucially, there are massive reliefs available when it comes time to sell or pass on the property.
So the crucial point is this. When you eventually decide to sell, the savings are just huge. Selling a standard second home will hit you with capital gains tax at 18 or even 28%. But if you sell a qualifying holiday let business, you can use something called business asset disposal relief, which slashes that rate all the way down to just 10%. To put that in perspective, on a £200,000 gain, that's a tax saving of £36,000. Massive.
Okay, this all sounds fantastic, but it is so important to get it right. Navigating these rules means knowing where the pitfalls are. So let's take a look at the common traps you need to avoid to make sure you stay on the right side of the taxman. First up, where your property is matters. A lot. Just look at the difference here between England and Wales. In Wales, the letting rules are way stricter. You need 182 let days, not just 70. And the potential council tax premium? A staggering 300%. Knowing your local rules isn't just a good idea, it's absolutely non-negotiable. These are the mistakes we see people make time and time again. The biggest one by far is just falling short of that 70-day letting rule in England. That one mistake can push you right back into paying expensive council tax. Others include not keeping those vital booking records we talked about, or simply forgetting to tell the VOA if you stopped letting. Any one of these can undo all of your hard work. And finally, let's look ahead. The rules around holiday lets are constantly changing, and being prepared is absolutely the key to protecting your investment for the long run. Here's a quick snapshot of what's coming up, and it's really important to have these on your radar. First, the specific furnished holiday let tax regime is being abolished from April 2025. This is a big deal, as it'll remove some of those great income tax and capital gains reliefs. However, and this is key, the strategy of qualifying for business rates to get your council tax bill down remains a completely separate and vital thing to do. On top of that, a new registration scheme is coming, and you might need a higher energy rating soon too. Staying informed is everything. So, let's quickly recap the key takeaways. Remember, the default is always expensive council tax. Your goal is to get onto business rates by hitting that 140 70-day rule in England. If your rateable value is under 12 grand, small business rate relief can get your bill to zero. And don't forget the potential to unlock those other major tax reliefs. And always, always know the rules for your specific region, especially if you're in Wales. Look, navigating all of this can be pretty complex, but getting it right can literally save you a fortune. For expert advice that's tailored to your exact situation, you should really get in touch with the team at Pro Tax Accountant. You can call them or even send a WhatsApp to the number on your screen, or just drop them an email. And for more helpful guides just like this one, make sure you subscribe to their YouTube channel. We really hope this has helped you on your way to a smarter and much more profitable holiday let.